Right now, somewhere out there, someone is about to make the biggest investing mistake of their life, and they don't even know it yet. Not because they picked a bad stock, not because they got scammed, because when the next crash hits, they're going to do the one thing that guarantees they lose. They're going to check their account every day, watch the number turn red, and eventually sell. Meanwhile, a much smaller group of people who did almost nothing different except prepare, are going to come out of that same crash wealthier than they went in. Same market, same crash, two completely different outcomes. Today, I want to break down the actual mechanics of why that happens. Not motivational fluff, but the real math and the real psychology. And give you a simple system so you're in the second group, not the first. Here's the thing almost nobody says out loud. A crash isn't a malfunction of the market. It's a feature of it. It's the toll you pay for the long-term returns stocks give you in the first place. So the question was never, how do I avoid a crash? You can't. The real question is, how do I make sure a crash doesn't wreck the progress I've already made? And ideally, how do I use it? That's what this video is about. 3 parts. 1. Why growth is more breakable than people think. 2. How often this actually happens. It's more often than you assume. 3. The system you can set up before it happens, so you're not making decisions in a panic laze. You've probably heard that growth builds on itself, small gains snowballing into much bigger ones over time. That part is true, and it's genuinely one of the most powerful tools an ordinary investor has. But here's what most explanations leave out. That snowball can be knocked flat in a way that's mathematically brutal. Picture 2 investors. Investor A grows their money steadily for a few years, then rides out a sharp downturn without touching it. Investor B grows their money the exact same way, then panics during the downturn and cashes out. Investor A is temporarily down on paper, but the moment the market turns, they're growing again from wherever they left off. Investor B locked in the loss, and here's the part that trips people up. A loss and the gain needed to undo it are not the same size. Drop 30%, and you don't need a 30% gain to get back to even. You need something closer to 43%. Drop 50%, and you need a full 100% gain just to break even. Losses are steeper going down than they are coming back up. That gap is where most people's long-term wealth quietly disappears. Not because the market failed them, but because they exited at the exact wrong moment and had to climb out of a deeper hole than the one they thought they were in. There's also a less obvious cost. Missing days, not just missing years. A huge share of the stock market's best-performing days in history have landed within days or weeks of its worst ones. Investors who step out until things calm down very often miss the sharp rebound that follows, and that handful of missed days can quietly cut decades of returns in half. The lesson isn't never feel nervous. It's that the moment you're most tempted to act is usually the worst possible moment to act. If you think a crash is a once-in-a-generation event, that's part of the problem. It makes you feel blindsided when it inevitably happens on your watch. There are really 3 tiers of decline worth knowing. Pullbacks, smaller dips, roughly 5 to 10% off recent highs. These happen almost every year. Most investors barely notice them in hindsight. Corrections, a drop of at least 10%. These show up fairly regularly, often more than once per decade, sometimes more than once per year. They're uncomfortable, but historically short-lived. Bear markets, a drop of 20% or more. Rarer, heavier, and they tend to stick around for months rather than weeks. But, and this is the important part, the recoveries that follow them have historically lasted much longer than the declines themselves. So if you're investing for 20, 30, 40 years, you are not going to avoid these. You're going to live through several of them. Planning as if you might dodge one entirely is planning to be caught off guard. Once you accept that, the entire strategy shifts. You stop asking, "How do I predict when this happens?" and start asking, "What do I have in place before it does?" Piece 1. The buffer that keeps you from being forced to sell downturn. The single biggest reason people sell investments during a downturn isn't that they've lost faith in the market. It's that they need cash for something in real life, and their portfolio is the only place they have it. Job loss, a medical bill, a car repair. These things don't wait for a convenient time, and downturns tend to cluster with exactly this kind of financial stress. A cash cushion sitting outside your investments, enough to cover several months of essential expenses, is what stops a life event from turning into a forced, badly timed sale. It's not designed to make you money, it's designed to protect the money that's already growing elsewhere. Piece 2. Make investing automatic, not emotional bunno. This is where a lot of people overthink it. You don't need to predict the bottom. You need to remove yourself from the decision entirely. Set a fixed amount to invest on a regular schedule, weekly, bi-weekly, monthly, whatever fits your budget, and let it run regardless of what the headlines are saying. Here's why this quietly works in your favor. When prices are high, your fixed amount buys fewer shares. When prices drop, that same amount buys more. Over a full cycle, this smooths out your average cost, and during an actual downturn, it means you're automatically buying more while things are cheaper, without having to talk yourself into it in the moment. The value of automating it isn't the math is a nice bonus. The value is that on the day your instincts are screaming at you to stop, the system doesn't ask your permission, it just keeps going. Piece 3. Spread it out before you need to diversify. Diversification gets treated like a checkbox, but most people do it wrong. They think owning 5 different companies in the same industry counts. It doesn't. Real diversification means spreading across different types of assets, different sectors, and different regions, so a downturn in one corner of your portfolio doesn't take the whole thing down with it. The uncomfortable truth is that diversification is hardest to stick to when things are going well. When one holding is outperforming everything else, every instinct tells you to lean into it harder. That's exactly the setup that leaves people overexposed when the tide turns. Concentrated gains can turn into concentrated losses just as fast. Staying spread out and periodically rebalancing back to your original targets means you're systematically trimming what's gotten expensive and adding to what's gotten cheap. It's a mechanical version of buy low, sell high, done without having to trust your gut. Here's something worth being honest about. None of the 3 pieces above are complicated. A cash buffer, automatic investing, and diversification are not secret techniques. You could explain all 3 to a 12-year-old. So why doesn't everyone do this? Because in the moment, it doesn't feel like a math problem, it feels like a threat. Your account is bleeding red, the news is using words like meltdown, and every part of your brain that's built to protect you is screaming to make it stop. This is a well-documented pattern in behavioral research. Losses simply feel worse than equivalent gains feel good. It's not weakness, it's wiring. But that wiring is actively working against you as a long-term investor. The fix isn't trying to feel calmer in the moment. That rarely works when your account is down double digits. The fix is deciding what you'll do before the fear shows up, writing it down, and treating that written plan as non-negotiable when the moment actually arrives. Your plan should answer, in advance, what am I invested in, and why? What will I do if my portfolio drops 20%? What will I do if it drops 40%? How long am I actually planning to hold this money? When the crash comes and your emotions are loud, you're not making a decision from scratch. You're just following instructions you gave your calmer, more rational self months or years earlier. Let's bring it together. Downturns aren't rare exceptions. They're a regular, predictable part of investing. Over the wrong moment can cost you far more than the drop itself. The fix isn't timing the market. It's 3 unglamorous things set up in advance: a cash buffer so you're never forced to sell, automated investing so buying continues without your permission, and real diversification so no single downturn can take everything down at once. And underneath all 3 of those, a written plan made when you're calm, that you trust more than your fear when the moment actually comes. The people who come out of a crash ahead aren't the ones who saw it coming. They're the ones who were already ready for it. If you want the next video where I break down exactly how to build a diversified portfolio step by step, what to hold and roughly how much, that one's coming next. Subscribe so you don't miss it.